First one is Pepsi. This is a stock that is widely held, I think in large part because certain stocks are easy to understand for investors. Pepsi, you can go buy a Pepsi, you can go buy a Coke. This has been around for a long time. This business is over 100 years old, if I'm not mistaken. Yeah, well over 100 years old. So Pepsi is a known commodity. They're primarily a beverage company, but they also do snacks. At one time, they owned restaurants. They owned Taco Bell, KFC, and Pizza Hut. And I believe they divested that, and now that's a separate entity. It is a large cap at $203 billion. And revenue is $91.9 billion. So this is a big company. Earnings per share the PE looks somewhat reasonable, but I'm going to get into the fundamentals a little deeper and then make a judgment call on that. This is a value stock, in my opinion. This is a food and beverage company. Dividends are 3.7%. And analysts think it's a little discounted. Over the past year, it's down 13.4%. So it's a down stock. Is it going to come back up? Over the 5-year, in my book, it's not a great stock because it didn't double in value. Every 5 years, I want to see stocks double in value. That is the goal. That way I can see my capital double in value. That's a very good rate of return. This one doesn't even come close, up 7.8%. With that dividend, maybe you're doing, 5% a year, which frankly barely beats the treasury yields. So that's not a very good yield overall. All right, let me answer a quick question. DDA, you can become a paid member. If you look at the details of the stream, there's a link, and then that's where you can become a paid member. Thanks for asking. Thanks for considering it. All right, so looking at Pepsi, let's look at their revenue growth. Revenue growth really tells me, is this business doing well? Meaning, are more customers coming and becoming customers? Are existing customers buying more of their product? And therefore, a healthy business, both should be happening. The revenues are growing. They're able to increase their prices because customers like the product. And they can maybe grow the types of products and the number of products that are being sold. In the case of Pepsi, it's quite it's a low growth situation. For a couple of years around COVID, I think people were at home snacking, right? We were stuck at home. Maybe we bought an extra bag of chips and maybe some extra beverages to put in the fridge. And they had growth in 2021, 2022. But in the trailing 12 months, just very slow growth. When I drill in and look at the quarterly, the last quarter, it was actually down by 0.5%. This is a big company. So for them to grow is difficult because it's a big number they have to grow on. Previous quarter was up a little bit. And you can see that each quarter, it's up or down a little bit in the last 4 quarters. So I'm not expecting a whole lot of growth out of Pepsi. I don't see some big force or factor being a big catalyst, a big tailwind for Pepsi. So it's not a grower. In my book, it's a value stock. It's a little bit of one of those safety stocks that, hey, people are going to drink their Pepsi. It's a affordable luxury or affordable treat that people can have. Bag of Doritos, a bag of Cheetos. Those types of things are easy for most people to afford. May not be the best for your health, but you can afford it. It looks like Tomas has joined. Thanks so much for joining. Buenas tardes. I appreciate you joining, Tomas. All right, so moving on Pepsi. So I'm not excited about the growth. It's a value stock. Let's take a look at their net margins and free cash flow. So the margin on this business is these guys produce a beverage, and it's mostly water and aluminum can or a plastic bottle, and the ingredients don't cost a whole lot to mix and bottle. So their margins are fairly good, almost 55%. Their free cash flow is good, $6.2 billion. It has come down a bit. It was almost at $8 billion. It's good to see that they've grown it over time. Now, this is a stable, well-known company. So I give them a little bit extra premium since they're well-known, very known company, very well run, by the way. But they're in a business that just isn't really exciting to me. It's just beverages. It's not like they're changing the world. They're finding a cure to some illness that's really, really bad. It's a little bit boring in my book. So $6.2 billion. They're not growing, at least for the trailing 12 months. They have pretty good margins. I took a look at their debt before the stream started, and their debt's okay. They have a little bit of debt. I think it's manageable, but they do have debt. $45 billion of debt. They have cash on the books of $8 billion. So they have net debt in my book of $37 billion. Now their EBITDA is $16.9 billion. So they could pay off their debt in less than 3 years. So their balance sheet's okay. It's not a hazardous balance sheet that has too much debt and they can get themselves into a lot of trouble. So I'm good with Pepsi's balance sheet. When we look at other stocks that are just booming, especially around technology or biotech, you oftentimes find that those companies have more cash than they do debt. That's a really good sign. That means that company's producing lots of cash, so much they don't need any debt. They just load up their balance sheet and they become super valuable. You look at those top 10 stocks that I showed early, like Meta, they have lots of cash. Google Alphabet, lots of cash. Microsoft, ditto. And that cash becomes the ability to really go into other businesses, expand businesses that are making lots of money. So cash is really good. Pepsi's a really old business, more than 100 years old, and they carry some debt. Now, the company's producing $67 billion of free cash flow. It's not growing. So at best, I would value Pepsi at around $100 billion because I take about $6 billion, multiply it times 15, I get to 90. And maybe I pay 90 to 120 billion for this company. And that's about it. It's not a name that I'm overly excited about because I just don't think the company's going to double in value every 5 years. I'd rather have a stock that gives me a chance of it being really special and really grow nicely. If I'm going to go into a food company, I'd prefer to go into a food company that's delivered way better returns. For example, Kroger. Kroger, over the past 5 years, is up 111%, and it pays a nice dividend. This is a retailer of groceries. Similar but different, but it's in the food category. And this is a much better proposition for me. I'm an investor in Kroger. I'd rather be in Kroger than in Pepsi for obvious reasons. It's going up, and you'll see that Kroger has better revenue, better free cash flow growth. Just all those fundamentals mean something. Also, Kroger is a very well-known company like Pepsi. When I look at Kroger, who owns Kroger, some really important super investors like Warren Buffett own it. Where Pepsi, I think, is more of a retail stock. A lot of investors like this dividend. And I'm going to caution you on dividends. I have nothing against dividends. And I think some investors really focus on having income from dividends. Not a bad thing, but I would just say companies know that they can prop up their stock price by managing that dividend. You've heard of the term, these dividend aristocrats. Well, to me, that's kind of a marketing ploy. It just shows that these companies continue to, make their dividend look attractive, so investors will come in and buy their stock. Well, that's fine, but dividends don't represent true value in a company. True value is revenue growth, profitability, free cash flow generation, the ability to load up on cash on the balance sheet and have no debt. Those are true fundamentals that make a company very, very valuable. So I would just say that I don't use dividends in my valuations, with one exception being real estate investment trusts, because there's no other way. But every other industry, I don't take dividends into account. I don't penalize a company for having a dividend unless they can't afford it. Then it would be a problem if they're providing dividends that they cannot afford. But in general, I think the reason Pepsi becomes a sought after stock is that dividend looks pretty attractive at 3.7, and it causes retail investors to buy into the company and create the market cap that they've created. But over the long haul, as mentioned, it just does not create the type of return that a stock investor should be satisfied with. Stock investing, we should get 10% returns, 15% returns. If you're into growth stocks, some years you should get 20, 25% yields in a particular year. You're going to see volatility. Not every year is going to be that great. But to have a stock that's a well-known commodity producing 7.84% return on appreciation for 5 years, to me, is not a passing situation. It's just something that I would avoid. So this goes out to the member that wanted to look at Pepsi. And as always, this is just my opinion. I don't recommend you buy, hold, or sell any stock I cover. But I commit to just giving you my comments as I see them and try to support my comments with fundamental analysis.